conference call of Apeejay Surrendra Park Hotels Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anup Pujari of CDR India. Thank you, and over to you, Mr. Pujari.
Thank you. Good afternoon, everyone, and thank you for joining us on Apeejay Surrendra Park Hotel Limited's Q3 and 9M FY24 earnings conference call. We have with us Ms. Priya Paul, Chairman, Mr. Vijay Diwan, Managing Director, and Mr. Atul Khosla, SVP Finance and Chief Financial Officer of the company. We would like to begin the call with opening remarks from the management, followed by an interactive question and answer session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I would now like to invite Ms. Priya Paul to make her opening remarks.
Thank you, Anup. Good afternoon, everyone. On behalf of the entire management team of Apeejay Surrendra Park Hotels Limited, I would like to extend a very warm welcome to all of you to our maiden earnings conference call post our successful listing on February 12, 2024. First and foremost, I would like to thank all our investors for the exceptionally strong response to our IPO with over 62 times oversubscription. The company, with over 55 years of a legacy, has started a new chapter in its journey, and we are enthusiastic about the promising road ahead. As committed, we have successfully executed our IPO objective of allocating rupees 550 crores towards the prepayment of loans, enabling us to achieve a net cash position. Our net worth has now increased to rupees 1,200 crores, and this, with our strong balance sheet and cash accruals, enable us to really look at inorganic growth in the years to come. Given that this is our first earnings call, let me give you a brief overview of the company, and following this, our Managing Director, Vijay Diwan, will run you through the key operational and financial highlights of the quarter and 9 months ended December 31, 2023. It has been the best ever Q3 and the best 9 months results for us. ASPHL is part of the Apeejay Surrendra Group, established in 1910, with a diversified presence in industries such as shipping and logistics, retail and warehousing, and hospitality. Our first hotel opened on Park Street in Kolkata in 1967, and this was the beginning of the journey to today. Over time, we developed a vision of leadership to differentiation, which is what has propelled our growth and helped us to create and innovate distinctive brands across hotels, brands, hospitality, and restaurants and bars across the country. So the brands that we have are in the luxury upper mid-scale brand and the upper upscale brand. We have created a niche of luxury boutique hotels, and we're really the pioneers of this. And that's because we used differentiation and innovation to create an exciting portfolio of hotels across the country. So the brands are the Park Collection, Zone by the Park, Zone Connect, and lately we've added an economy budget brand called Stop by Zone. Our presence is over 20 cities with 30 hotels right now and 2,298 rooms. And we operate these hotels through a mixture of models. We own mostly the Park hotels, whereas we have leased properties and asset-light properties across the other brands, giving us a good mix of ownership, management, and lease properties, and that's the way we will continue to grow the brands over the years. A large part of our success is the food and beverage segment, and because we are passionate about creating brands, we've also done that in the food and beverage space across not just tier 1 cities, but also tier 2 and tier 3 cities. And these bars, nightlife, and clubs and spas contribute about 44% of our revenues. And it's enabled us to create a lot of engagement and stickiness with customers because we create spaces that people enjoy spending time in. Another business that we run is the iconic brand Flurries. This is something that started in 1927 on Park Street in Kolkata by a Swiss family. We now have about 75 of them across the country. This is in the bakery, confectionery, cafe segment, which is one of the fastest growing segments
in the country. ARR has increased by 14% and it stood at 7,286. RevPAR also increased by 14% and stood at 6,562. Overall room revenue increased by 15%, F&B revenue increased by 14% to record a total revenue of 164 crores and an EBITDA of 61 crores at 37%. In terms of 9 months ending, we have achieved revenues of 436 crores with an EBITDA of 152 crores, which is again a 14% improvement over last year. And the EBITDA margin stood at 35%. At the end of 9 months, we have achieved a PAT of 50 crores, which is a 12% Y-on-Y growth and a 35% improvement over last year. Again, we have maintained our leadership position in occupancy, with occupancies at 92% at the end of 9 months. In terms of ARRs, have grown by 12%. RevPAR has increased by 13%. And is also on a very, very strong footing, and we plan to increase the number of outlets of Flurries from about 83 at the end of this financial year. We plan to double these outlets over the next year. We remain committed to sustainable growth, our green transition, and for providing superior corporate governance and value for our customers. Thank you.
So should we open up the floor for question and answer session?
Yes, sure.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Sagarika Chetty from Anand Rathi Shares and Stock Brokers. Please go ahead.
Hello, am I audible?
Yes, ma'am.
Thank you so much for this opportunity and great set of numbers, specifically in the quarter just after the IPO. So my first question is, in terms of the occupancy, you have a very high occupancy compared to your peers. So any specific reason for this higher occupancy compared to the industry average? If you can shed some light on that.
Occupancy percentage has always been exceedingly high at Park Hotels. Of course, the reason is that obviously we have a very high percentage of loyal customers. Percentage of repeat customers at the park is higher than that of competitors, close to 25%. Very significant is that we run an AI-based revenue management system, which makes a key difference. Third is that we run our hotels as entertainment destinations, and that leads to very high occupancy on the weekends, and it accounts for overall occupancy being high at the Park Hotels. We have also delivered in terms of occupancy, the highest occupancy even during the 2 years of COVID in the country. In the first year of COVID, we recorded an occupancy of 67%, and in the second year of COVID at 79%, which was also the highest in the country. So the Park brand, as I explained, enjoys a 25% premium in terms of occupancy, and it will continue to do so. This is our biggest strength in terms of the hospitality business.
Yes, sir. That gives us a lot of insight. My second question is, given your expansion plan, the plan which is coming up in the next 3 to 4 years, what growth rate are you expecting in the next few years? And would it be a mix of ARR and occupancy growth, or specifically occupancy dependent growth? If you can shed some light on that as well.
The way the industry is at the moment, if you look at all the industry reports, double-digit growth is expected, and it is going to be in the range of 12 to 14%, whether we look at Crystal reports or we look at hotel industry reports published by HTL or Hotelivate. The growth rate expected is going to be in the range of 12 to 14%. We have had a very strong Q3. We are also expecting a strong Q4, and going forward also, the industry is really poised for strong growth. If you look at the passenger arrivals, they are at Indian airports. They are also at record high. The previous record was somewhere around 14 crores of domestic passenger arrivals. It's already been exceeded last year. It's reached 15 crores. In terms of office space occupancy, that has also significantly grown, particularly in the last quarter. It has shown an increase of 19%, and all this is actually going to support the growth of the hospitality industry. We have achieved a very strong quarter, and we look forward to very strong quarters going forward.
Understood, sir. And my last question is on if you can provide some figures regarding the CapEx plans for the next 2 to 3 years.
So in terms of our expansion plans, the way they are, we are looking at doubling up of our inventory from roughly about 2,300 keys at the moment to somewhere around 4,600 keys. Currently, we have about 15 lakh square feet of development which is embedded in our balance sheet. We have initiated the projects. We have for 3 of our projects for our expansion of this, for our development of this FSI. For 3 of our projects, we have already appointed the designers. A lot of many of these projects today are going ahead in terms of permissions. In terms of our large project at EM Bypass, which is in Calcutta, which is a 6 lakh square feet development, we have signed a joint venture development agreement with the Ambuja Neotia Group, and this project is divided into 2 halves. 51% is going to be used for the development of the hotel, and 49% is going to be used for the development of apartments, and these apartments are going to be sold. So from the 3 lakhs square feet of apartments which will be sold, from the proceeds, we are going to be developing this hotel. So the hotel essentially would be free of cost. So what is happening in terms of this development, that one is the agreement has been signed and it has got registered. The second most important thing is that we have begun the process of the selection of the designers, and we hope to go to the Calcutta Municipal Corporation for the permissions over the next quarter or so, and we hope to break ground during this financial year itself for this project. For our other project, that is at Pune, the design work is already complete. The designers were appointed earlier. We are in the last stage of the permissions, and very soon this project will also have groundbreaking soon enough. And similar is in terms of our development at Visakhapatnam and Navi Mumbai. So out of these 15 lakh square feet of development which will happen, initiation has already happened in terms of 11 lakh square feet of development.
Understood. Thank you so much.
Thank you. Ladies and gentlemen, in order to ensure the best quality of this call, please refrain from using speaker mode and pick up your handsets while asking a question. Thank you. The next question is from the line of Sumit Kumar from JM Financial Institutional Securities. Please go ahead.
Hello. Am I audible?
Yes, sir, you're audible. Please go ahead.
Yeah. Good afternoon, Mr. Devan, Ms. Paul, and the team of Park. Congratulations on a good IPO and subsequently a very good set of numbers. My first question would be on the upcoming hotels, particularly the ones in Digha, Patiala, and Chettinad. If you could guide us on what would be the expected commissioning dates for these three hotels. And the second question would be, what is the contribution of Pluris for the third quarter and 9 months, if you could give us the details?
Okay, so in terms of firstly Digha, this hotel is a 65-room hotel. We are at the last stages in terms of permissions, and we are expecting this hotel to open within this month. So any time during the course of this month, this hotel is expected to open. Teams are already in position. The general manager has been appointed with his and all the department heads and the entire team is in place. So this hotel is expected to open anytime soon. Work is going on in terms of both Patiala as well as the project. Again, the teams are getting constituted. The general managers for both the properties, they have been appointed, and we expect these hotels to open any time in the first quarter of the financial year, of the next financial year. In terms of your question, in terms of Pluris continues to perform very significantly in terms of the results. The Pluris division at the end of 9 months has the revenue of 35 crores, which is a 27% improvement over the previous year. And it has recorded an EBITDA of 15 crores, which is a 14% again improvement over the previous year. So, the Pluris division has produced an EBITDA of 6.62 crores on a total revenue of 35 crores, which is 19% of the top line, a 33% improvement over the previous year. Now the Pluris, the way it continues to outperform the market. Its growth of 27% is very, very significant. And more significant is that the EBITDA margin of 19%, it is the highest and the best in terms of the peers.
Sure, sir. I'll come back in the queue for any further questions. That's all from my side. Thank you.
Thank you.
Thank you. The next question is from the line of Nikhil Agarwal from VT Capital. Please go ahead. Mr. Agarwal, your line is unmuted. You can proceed with your question.
Good afternoon, sir, and thank you for the opportunity. Hello.
Yes.
Yes. Ma'am, good afternoon, ma'am. Actually, coming back to your previous question, like we did a rough calculation from margins on Monginis, and it came to about 30% plus. But our margins in Pluris is about coming to about 11-12%. So just wanted to understand about why is this different margin differential coming up to? Hello.
Tourist margin is at 19%, which is the best in class in the industry. I don't know from where you are picking up the 12% margin. Tourist, as I just mentioned, has produced a stellar performance alongside the hotel performance.
And I think Monjinis is not in the bakery, cafe, kind of restaurant segment that we are in. So I don't know.
Okay. So are we expecting the margins of 18% to continue?
Yes, we expect these margins to continue. There is no question that these margins will not continue. In fact, they have improved on a quarter-to-quarter basis.
Mm-hmm. And in FY22, we had margins of about 25%, and in Tourist, and 23 it fell down to 17-18%. So what led to the margin increase in FY22?
Oh, this is the bulk of the business. Again, firstly, like hospitality business, the business how it works is that the best quarters are quarter 3 and quarter 4. So already, and in terms of the tourist business also, the festive season starts somewhere in October, and again the quarter 3 and quarter 4 are very strong quarters. So this margin, which is currently close to 19%, is expected to further improve in quarter 4. And yes, it may not reach the 25% mark because there have been new openings in Mumbai. A lot of openings are taking place in Mumbai, and the operations there have produced a very strong performance. But they are still to be fully performing in terms of the EBITDA margin. But as they stabilize, this margin will for the outlets which will stabilize, the margin will be in this range of 22 to 25%.
Okay, got it. And so, in your hotel business, what percentage of your rooms are sold to international tourists currently?
Right?
What percentage of your rooms are broadly sold to international tourists or international corporate
So the Park is a very strong Indian brand. This is a very big strength that we are a powerful and strong Indian brand. And we also have very high percentage of domestic market. So yes, the international tourist percentage has improved. Currently it is at 9%, but 91% of our business at the moment is domestic. And domestic market continues to be strong, and we are very strong beneficiaries of this.
Okay, you said 9% international tourist. What was it pre-COVID?
Pre-COVID, this number was 20%.
20%. So, are we seeing any improvement going forward, or are we going to rely on the domestic market completely?
So as far as international traffic is concerned, as the latest report published by Department of Tourism, it's 90% back, and is expected to be in the range of 100 to 110% in the coming year. This year, India has recorded 9.2 million. In the calendar year, it's recorded 9.2 million foreign tourist arrivals, to the best being at 10.6 million. And the government India is expecting that this number of 10.6 will be achieved and will be exceeded in the next financial year. And we will also see an increase in a number close to the pre-pandemic levels. But our market is a strong domestic market, and the domestic market is strong and will continue to be strong for us as well as for the country.
Okay, great. And what about the retail and corporate mix, if you could highlight on that as well?
So Park has a very strong mix of both leisure as well as corporate travel. Currently, 42% of our business is coming from corporate, and 42% of the business is also coming from leisure. But within this leisure, we have a new segment, which is the B-leisure segment. So actual leisure is 17% and B-leisure is 25%, which is a combination of business and leisure. 7% is airlines, and the balance is FIT travel. So more and more travelers today, more and more companies are encouraging people to travel both for business and leisure. So we are tracking this segment. So B-leisure segment for us has already hit 25%, and it will continue to grow.
Okay. So it's B-leisure that you said. Hello?
Yes.
Okay. And lastly, on your expansion, do you have expansion plans for your other restaurants, like someplace else, and other small restaurants in Calcutta that we have in the Park Hotel? Any expansion plans for that?
So someplace else currently, of course, is in Calcutta, and then we have also opened at the Geo World Drive in Mumbai, and currently we are looking at other opportunities, and as those opportunities are finalized, we would be informing all of you.
Oh, okay, got it. That's it from me. Thank you so much.
Thank you. A reminder to all the participants, if you wish to ask questions, you may press star and 1 on your touchtone phone. The next question is from the line of Santosh Sinha from MK Global. Please go ahead.
Thanks for taking my question. My question is regarding margins. So what we see is that in Q3FY24, the margin was somewhere around 37%. And last year also, if you look at Q3, it was 37%. So despite around 13% year-on-year increase in revenue, we have not seen the operational benefit passing through to EBITDA margin as such. So operating leverage benefit has not flown through to EBITDA margin. So what has led to that? And is there any guidance for margin as such by the company?
So improving efficiencies continue to be a key focus area of the management, and it will be part of our strategy going forward as well. 37% is a very strong EBITDA margin. Here there has been an increase in cost of about 2% in terms of payroll expenses, if you were to see the details of the result. And this 2% increase in payroll takes the payroll expenses from 18% to 20%. And this is largely on account of ESOPs. We have the ESOP cost of about 1.8 crores has led to this increase largely. And secondly, we have also come out of the COVID period, so there has been an increase in terms of salaries and wages. So overall, as a result of this, the payroll expenses are at 20%, but they still continue to be the best in class. If we were to compare it with the industry peers, they continue to be the best. Despite the fact that there has been, we have provided for ESOP expenses. We are among the few companies in the country who have provided for ESOPs in the space of hospitality. And we are very confident that as a result of ESOPs, our teams are going to be further motivated and further committed, and this will lead to better results. The rest of the increase, there has been an increase of 14% in terms of top line, and that has been translated back into the EBITDA of 14%. But I expect this to further improve in the year going forward, in the quarters going forward.
By 100 to 100 basic points, we expect margins to keep on improving as the quarters going forward.
Okay. My next question is regarding the financial cost. Actually, that was 179 million in this quarter. So I think that the company has now repaid the debt. We'll see that declining it from the next quarter.
Yeah. So we have repaid the debt from next quarter. There won't be any financial cost from the quarter 1, 25, and from March month also, we will not have a finance cost. So debt cost will go down to zero.
Thank you. Thanks for taking the question.
Thank you. The next question is from the line of Pranav Shrimal from PINC Wealth Advisory. Please go ahead.
Yeah, good afternoon, sir. Thank you for the opportunity. I had a couple of questions. One, if I could get to know the distribution segment-wise, that is, how much does upper upscale bring, how much does the upscale bring, and how much do the economy hotels bring? Hello?
Could you repeat your question? I didn't get it clearly.
Yeah, so we have three divisions of our hotel. One is luxury and upscale, upper mid-scale, and economy. So I wanted to know the revenue contribution.
Okay.
Top line.
Yeah, got it. So at the moment, the mix is like this. So 90% of our business is coming through our own hotels, and all our own hotels are largely operating in the upper upscale segment. 90% of the business is coming through that, and 7% of our business is coming from Fluries, and roughly about 3% of the business is coming from the managed properties, which are largely in this upper mid-scale segment.
All right, got it. And another question, what would our developmental costs be per key?
Can you repeat the question?
Hello? Yeah, cost per key in the park group.
So depending upon the market, but by and large, we are looking at our development is going to be in the range of about 1 crore per key in this upper upscale segment. So we manage our costs again better than our competitors. We do not overspend, and we are able to create great products in this range of about 1 crore per key.
Awesome. Got it. Thank you so much, sir. Thank you so much.
Thank you. Participants, if you wish to ask questions, you may press star and 1 now. The next question is from the line of Pradyumna Chaudhary from JM Financial. Please go ahead.
Yeah, hi. Congrats on your listing. So, on the revenue side, I was just trying to understand. Right now, 90% of our revenue comes from owned or leased hotels, where almost 50% is from room revenue, is my sense, right? And the remaining comes from managed hotel, which is very small, 2%, and Fluries is another 8-9%. So I do understand the growth triggers are there in the managed hotels revenue and the Fluries, but these are very small. So the big revenue driver going forward would still have to be, like, if the needle needs to be moved, it needs to come from the owned and leased hotels portfolio. So what really is our strategy on this front going forward? Like, mainly would it be ARR and RevPAR driven, or do we plan on adding more owned and leased properties as well?
So as we said, we are going to be adding 3 leased properties. So those are getting added in the next financial year, starting with 65 rooms of the property in Digha. So a total of 116 rooms are coming in terms of the leased properties, and this will make a significant difference to the growth next year. Plus 232 overall, about another 100 and another 116 keys also are getting managed on the managed side of the property. And plus we are going to take at least 10% of our current property, current inventory, the upgradation and renovations. So that those combined ARR as a result of that, the new rooms is going to significantly improve our ARRs further, and the market continues to have this huge demand-supply mismatch. So we expect a very, very strong ARR growth being present in the central business district. Growth is also going to come on the side of the addition of the leased properties. The entire revenue will be booked to our total revenue. And then, of course, we see a very strong growth on the F&B side of the business, not only in Fleuries, but with the opening of new food and beverage outlets, upgraded food and beverage outlets. So we are expecting a very strong quarter four, and also expecting double-digit growth in the next financial year as well.
Understood. That's really helpful. And beyond, like you spoke about 155 rooms coming on the leased property side in FY25 itself. And beyond FY25, what does our pipeline for room addition look like on the leased or owned property side? Because, see, the needle mover would be there itself, right?
So one very important thing which Ms. Paul also mentioned, and I also mentioned, that our balance sheet today is firstly very, very strong. So it will provide us that opportunity. It gives us that strength to look at various opportunities on the lease side as well as on the buy side. So we would be looking at further properties on lease going forward, and also look at other properties in terms of our expansion going forward. Leased will be a very strong focus in the coming year. There is no question about that. And of course, Fleuries will continue to grow. We had 75 outlets, now going up to 83. We definitely plan to double these outlets as well, and have a significant amount of revenue also coming through the expansion of Fleuries. And yes, leased properties will continue to be a focus area. Additional leased properties, continue to be a key focus area going forward.
And we are open to taking already built properties as well, is it?
Yes, the balance sheet is strong, and if it offers a good opportunities come, we are open to it, definitely open to it.
Understood. That was really helpful. Thank you.
Thank you. The next question is from the line of Saurabh Jain from HDFC Life Insurance Company Limited. Please go ahead.
Yeah, hi. Thanks for the opportunity, and congrats on a good set of numbers. I have two questions. First is on the what is the ESOP cost for this quarter? So I see a lot of increase quarter on quarter. So how should we factor the ESOP cost going ahead?
See, the ESOP cost in YTD 9 is 0.83 crores, out of which 1.23 is for the quarter 3. And the next quarter 4 also will be about 1.25 crores. And forward will be about, from next year, it will be around 4 crores, because it is fully a cost.
So next year, the whole year, what will be the cost?
Around 3.5 3.75 to 4 crore, because next year the cost was April to August will also be there. This year, because the software vested from August, so that cost is not there. Around 2.75 crore you factor in.
Okay. And just on the second question is on slide 26. So if we see the numbers of Q3 FY23 and Q3 FY24, it looks like the management fees has dropped year on year. So just want like a comments, why is that?
So let me open slide 26. One second.
The management fee is okay. Yeah, in terms of percentage, year to date the management fees is on a higher side, 9 months, but it's around on the path towards going to year end. But it's 9 crores at present. What is in quarter three there is slight dip in this management fee, but it is 9 crores versus 6 crores same time last year, 9 months to 9 months. And year end, we do expect it to remain as we expect to go on a high. So again, quarter four will be a stronger one in management fees.
Any particular reason for the drop in quarter three, if we see from a year-on-year perspective?
What are the reasons? I don't think there was a drop in reason. It was, I think, just some other accounting things. So it's nothing to do with drop in things. It's almost same thing. There's slight dip in. There could be when you work out the incentive fee at times, with some owners it gets booked in the quarter four. If incentive fee comes in the every quarter, so that at times gets booked in the quarter four. So that's what will happen.
Okay. And just one more question. So, just want to understand, so slight confusion between slide 26 and slide 10, where you say the 9-month revenue, so 44% F&B. This is excluding the flurries, or this is including flurries as well?
Slide 10? It includes
slide 10. Yeah, slide 10, you have put in the footnote that this excludes the revenue from flurries. So this 44% number of total revenue, so flurries is not included in both numerator and denominator for this?
No, flurries is included in both FY23, FY24, both it's included. It includes flurries.
Sorry, I didn't get that.
No, on slide 10 he's talking about.
On slide 10, the flurries is included as a part of F&B income, your percentage to total revenue.
Okay, so we should ignore the footnote then.
Yeah, that is the DRHP note. It is part of the DRHP thing here. It's part of DRHP thing, so it's but it is not. It is included in this.
Okay. Thank you. That's all from my side.
Thank you. The next question is from the line of Jayveer Shekhawat from Ambit Capital. Please go ahead.
Sure. Thanks for taking my question, and management, congratulations on your meeting earnings call. My first question is, I'm trying to understand your pricing power here. So if I were to compare your average room rates, let's say pre-COVID and FY19, to where they are currently, I think these have increased by about 20-odd%. And if I were to compare that with the other listed players, these have increased by 40 to 50%. And your occupancies might have increased by around 2 to 3 percentage points. One, is it a conscious strategy to keep your prices lower versus your competition so that you can continue to attract your loyal customer base? And second, is there any other thought process behind not really taking that cheap price increase, or do you still believe that you can possibly catch up on that in the coming 2 years? Your thoughts there.
So first thing which we need to understand that the park is operating in the upper upscale segment. And in this segment, it is not the luxury segment and it is also not the upper mid-scale segment. In this segment, which is in the upper upscale segment, we are occupancy leaders, we are RevPAR leaders, and we are leaders in ARR as well. So as per the industry report, the park continues to lead on all these 28 of the 30 data points. So that will continue to be our strategy. Secondly, we are present in the key growth markets. And within these key growth markets, we are strategically located in the central business district. We strongly feel that in the central business district, in all these key growth markets, there is virtually no supply coming in, or there is very limited supply which is going to come in. And this is going to significantly help going forward our ARRs to go up further and further up. Though supply is coming in a very limited way in the cities, but in the micro markets in the central business district, there is virtually very, very limited supply, a very high ARR growth going forward. So we are market leaders and we will continue to be in this upper upscale segment, market leaders on all three parameters of occupancy, RevPAR as ARR. Also, it's very important that the RevPAR actually is the key, is the crucial or the key indicator of a hotel performance. Hotels which have high RevPARs also have very high profitability. Yes, there is improvement required in efficiencies. We are already at 37% EBITDA for quarter three, and we are further looking at it, and we expect a strong quarter four as well.
Sure. I think my follow-up would be in terms of understanding how much of a pricing power you still have. Because I do listen to what you have stated in terms of your RevPAR leadership across the markets. Let's say looking forward, because there is possibly only little room for your occupancies to grow further, given the dynamics of a hotel, running a hotel. I just want to understand, the ability of yours to really price at a much significant or aggressive way versus your competition. Or do you think it's likely to be in line with the overall industry-led ADRs?
I expect this to be better than the industry in the quarters going forward, because as I explained, there is virtually no supply coming in the central business district. Secondly, we are upgrading. We have begun the process of upgrading our properties, or as you can say, the renovating of our properties. So with the upgradation and renovations, the blended ARR, which will come. So if I was to renovate 10, which we are going to do, the 10% of the inventory, so the pricing increase is also going to happen in the upgraded and renovated rooms, and there is significant headroom for blended ARR to be much higher than the ARR for the property itself. So if 10% of, say, 20 or 40 rooms are getting renovated in a particular property, so the ARR on those renovated rooms is going to be much higher, and this process of renovating and upgrading our rooms will continue over the next 3 to 4 years, resulting in increase in ARRs further. The market is strong and it will continue. It looks strong. It will continue to be strong. We are at the beginning of the start of the upcycle in the hospitality industry. It has sort of just started, and the best for it still to come.
Sure, Mr. Dewan, that's very helpful. Lastly, could you call out any of those specific markets that have performed very well across your entire portfolio, and then which ones are lagging?
So if we were to look at key performance, our hotel in Calcutta, the Park Calcutta, continues to outperform the market. It has already it has achieved for the 9-month ending 100% occupancy. And with that 100% occupancy, it has recorded an ARR for quarter 3 of 8,612. Our second best performing hotel would be the Park New Delhi, which has recorded an occupancy of 93%, which is also very, very strong. More significantly, the ARR for quarter 3 for Delhi has been 9,058 rupees, and it continues to. No, sorry, one second. There is an ARR. ARR for Delhi is actually 9,693, and the RevPAR for Delhi is 9,058. And this hotel, Delhi being a very strong market, these ARRs are continuously going further up. And in terms of the occupancy for our hotels, they continue to be strong. As I said, Delhi 93%, Chennai also did 93%, Kolkata, of course, 100%. Hyderabad is at 88%, Bangalore 87%, and Navi Mumbai at 93%. Now, compared to the market, all hotels are doing exceedingly well. But if you were to look at high performance, Calcutta 100%, lowest would be then Bangalore at 87%, but it is also showing a lot of promise.
Sure. This is very helpful, and wish you all the very best. Thank you so much.
Thank you. Next follow-up question is from the line of Sagarika Chetty from Anand Rathi Shares and Stock Brokers. Please go ahead.
Hello. So you had specified that the Flurry outlets will increase to 83, and then you're planning to double it. Can you specify a specific timeline for the doubling of outlets across the country?
Currently, Flurys is present in West Bengal. It has 66 outlets, and it has 8 outlets in Maharashtra between Navi Mumbai and Mumbai. We are looking at, as I mentioned, a lot of Flurys outlets are about to open now itself. Between 8 outlets are going to open within the month of March itself. 2 are opening at the Mumbai airport, and then there are 2 opening at the Bhubaneswar airport, and the balance 4 are opening in West Bengal. And in the months of April and May, another 8 units are opening. 5 of them are Mumbai, and then 2 in Siliguri and 1 in Darjeeling. And expansion of Flurys is a continuous process. We plan to capture over the next year as many airports as possible in terms of our expansion plan. We also plan in the next financial year to further consolidate our position in West Bengal and Maharashtra. And very soon we are ready with our kitchen, with our factory for expansion into Hyderabad. It has sort of just got ready, and very soon we will see Flurys in Hyderabad as well. We are also looking at expanding in the city of Delhi in the coming financial year. So that in these cities, with these cities and the consolidation in Bengal and Maharashtra, we should be having the doubling of the inventory. But Flurys on the whole over a 5-year period has a pan-India plan to be present in all the metro cities. And at the end of 5 years, we expect the number of Flurys outlets to grow to about 350 or so.
Understood. That was very helpful, sir. Another question was, you mentioned 10% of the property would be upgraded or renovated. Can you shed more light on the same? Exactly what is the plan or outline?
Can you just repeat the question?
Okay, so you had mentioned right a few minutes ago about 10% of the property would be upgraded. Now, correct me if I'm wrong. So can you just specify exactly what is the renovation plan timeline? Right?
Question. Yeah, okay. The renovation expenditure we have planned of renovation is about 40 crores per annum, and this and 10% of the rooms will be existing property taking into renovation, and which will lead to about more than double-digit increase in the blended ARR of that percentage of the inventory which is taken into renovation. And the renovation plan is already in force on the place. So we will be taking just for example, in one property we will take, in Delhi we will take 2 rooms. So the 2 floors and the 28 rooms, each 230 rooms, and which will take the ARR from to about 10,000 to about 11,500 for that part of the inventory which is taken. And the market has also, in that way, we have a renovation plan.
Okay, so I understand the point, but I'm just not getting exactly the specifics of the renovation plan. I understand you gave me an example, but is there a specific property that is going to go under renovation in the near-term period, or a specific plan chalked out regarding this?
Plan has already been chalked out, which of course, but in terms of how we'll take properties into one by one properties, and most of the rooms will be taken into renovation and hotel industry generally as we take in the first half of the year, and will be as they come back from the project, the actions will be taken. So plans are already chalked out. Of course, we will by the time of the next quarter we will be sharing with you.
Okay, understood. Thank you.
Thank you. The next follow-up question is from the line of Nikhil Agrawal from VT Capital. Please go ahead.
Yes, thank you for the opportunity again. Just wanted to ask, the Apeejay Surrendra house in Calcutta, that is under this listed entity?
The building, Apeejay House?
Yes.
No, that's not.
That's not. Okay. And what are the rental costs for Flurys outlets? Like for FY23 and 9 months FY24, what were the rental costs?
Atul?
Yes, Flurys rental costs are about 10 to 12% of the total revenue in FY9. You want it? Yeah. So in terms of have got the rental cost about 2 crores into FY YTD this year versus 1.5 crore YTD 9 months last year.
2 crores in FY23.
Yeah, this is 9 months. I'm saying 9 months versus 9 months.
Okay. Got it. That's it from me. Thank you.
Thank you. Participants, if you have any questions, you may press star and 1 now. As there are no questions from the participants, I would now like to hand the conference over to the management for closing comments.
Thank you, everybody, for your very active participation and questions on our maiden earnings call. I know that we will, if you need any further clarifications, we'd be happy to answer your questions. You can reach out to us or to CDR India, and look forward to further rounds and learning more from you. Thank you so much.
Thank you. On behalf of Apeejay Surrendra Park Hotels Limited, that concludes this conference. Thank you for joining us, You may now disconnect your lines.
Thank you. Should we stay on?